Hello everybody. I wanted to share my thoughts on what is currently going on in the market. So we're having a bit of a correction. I think this is very much healthy, and I made my arguments that we're due a slight correction in a video in October of 2024. The S&P 500 has had a great couple of years, up between 20 and 25% a year. So that's 50% once you cumulatively compound that, and probably 60% since the lows in September of 2022. And obviously the Nasdaq has done even more than that. This is an opportunity for investors that are smart and rational to keep their head when some people in the market may be losing theirs. I think there is a lot of short-term hype trading going on at the moment. That's evident because certain very popular retail stocks have gone up a whole bunch, and they have been very disconnected from their fundamentals, to put it bluntly. You could even see this with HIMS. I think HIMS is starting to transition to being a retail first company, which is not necessarily a bad thing, but you always have to look at the price and value. And what we saw with HIMS, a company which I've stated is my largest holding and I thought was heavily undervalued in January 2025 at $20 to $30 a share. You know, some GLP-1 success came about, they had their Super Bowl ad, and HIMS went parabolic to $72 a share. There's almost no rational explanation for it going up that fast, other than maybe short interest, but the main one being is that a lot of short-term money jumped on the GLP-1 bandwagon. And that would make sense because subsequently the shares have crashed 50% from that high of $72, and semaglutide has since been removed from the FDA's shortage list. The facts are, most stocks are not in a bubble based off quantitative metrics. Large parts of the market were moderately expensive and still are a little expensive, but we're also at the precipice of one of the most exciting technological transformations in human history. And that's what you've got to remember, is like, yeah, the market goes up, the market goes down. We all know the game. We all know the force of American capitalism that have driven the indexes up hundreds of fold over the last 100 years, right? But we also know throughout history that there are peaks and troughs, there are crashes and corrections, and all that will happen in these corrections is money will be transferred towards the people that will actually keep their heads. It's all about discrepancy between price and value, and let me give you some examples, right? So in my previous videos about HIMS, I stated that now I think HIMS are worth roughly $100 a share. My valuation models are not complicated, and this is a ballpark figure. This is the way you play it. It's like HIMS goes up. If HIMS is getting towards $100 a share, I start to liquidate and take that position off because I might be wrong at exactly $100 a share. I think the precise value for my DCF was 94 when I released the video. So I start selling off shares, particularly because HIMS have gone up so much that it's now a greater weighting within my portfolio. As HIMS approaches 100, I sell off more. If HIMS was at $150 or $200 and it got to $200 today, I would liquidate my position entirely because I have no loyalty. But a problem when a lot of retail investors come into the market is they do have a huge amount of loyalty to certain stocks. Stocks like Tesla, SoFi, Palantir, and 2 out of those 3 names that I've mentioned, I've actually held in the past, and 1 I still have a holding of today. I was an investor of Palantir, I bought at $15 a share. Some Palantirians will think I'm nuts, but by the time the share price got up to 50, I was pretty much out of it. Then it traded at around, I think, 45 to 50 times enterprise value to gross profit, with 25 to 30% forward revenue growth. And I was putting a huge premium on Palantir shares because I understood that they were most likely going to be a huge AI winner and maybe the default operating system in the AI revolution. However, you know, stocks can get a bit excessive as well, and it all depends on the way you want to play it. I'm just saying, when a lot of new people run into a story, and Palantir is a great story, very, very easily that weight can come out the bubble. That's what happened with HIMS and GLP-1. The difference with HIMS is, quantitatively, HIMS looked at much better risk reward, or much better value, I should say, compared to Palantir. You could see the same thing with Tesla, right? Before Tesla's self-driving event, and I understand what they talked about in the self-driving event increases their valuation from a business perspective first, which will then translate into numbers. And I'm a massive autonomous driving bull, right? A massive autonomous driving bull. But when Tesla got between $400 and $500 a share, just think about it. It was trading at more than 200 times forward earnings. It had barely grown on the year. Automotive revenues were shrinking. Yes, they've got a good energy storage business coming up. Yes, they've got recurring revenue from FSD. But it's trading at 200 times forward earnings with deteriorating margins and very slow, not even really double-digit growth, or at the very most, I think the analysts are forecasting low teens growth. And that's it. And you have to say, look, in order for Tesla to be trading at this price, at like $1.2 trillion market cap, or I think it maybe got even more than that, you have to really believe that Optimus is going to be the humanoid robot of the future, that Tesla are going to take huge amounts of full self-driving market share. And the problem is that a lot of retail investors run into it saying, obviously, to all of those questions, without really understanding the fundamentals of stock investing. And then the moment that the water gets rough, then they exit. And that's why you're seeing massive crashes in the stock market. That's what you've got to remember. It's all about thinking about business, discrepancy between price and value. Growth investing is great because growth companies grow, right? The best performing stocks of the last 25 years, Tesla, Nvidia, Netflix, Amazon, these are all growth stocks and they grow, right? Coca-Cola is not growing much faster than the price of Coke is growing. And in fact, their revenues have grown slower than the price of Coke is growing over the last 10 to 15 years. But you really have to think about that risk reward and that discrepancy. And that will keep you rational, because if you don't know roughly what your stocks are worth, then you're also going to panic in this market. You've got to keep your head. And fundamentally thinking, if you believe in the big AI technical logical revolution that's going on right now, really think in your head, is the S&P 500 and the NASDAQ 100 going to be lower in 5 to 10 years? My opinion is that if the S&P 500 and the NASDAQ 100 are lower within that time period, or significantly lower, something has gone massively wrong within the world, right? Amazon, Microsoft, Alphabet, Nvidia, Meta. If all of these companies have suffered, something has gone wrong. So over a 5 to 10 year period, if you believe in the technological revolution, these indexes are going to be higher. The market typically crashes very quickly as well. So it's like very, very intense pain. So what I would say is, know what your stocks are worth, know what prices you reckon they're buys at, know what prices you reckon that sells at, and be thankful for the volatility, because volatility creates opportunity. It's all about discrepancy. Just going back to the HIMS example, throughout the whole of last year, I thought HIMS was worth between $60 to $70 a share. When they were going up in February 2025, my fair value estimates were roughly $75 a share. And again, I'm not using PhD level maths to get to this. And a lot of it is just based off ratios. HIMS are trading at 4 or 5 times gross profit with 60-70% revenue growth. This is not normal in the market, particularly because they are free cash flow profitable, have a great management team, etc. When HIMS got to $60-70 a share, I actually sold most of it between 50 and 60. I said, right, here is time to just de-risk. And that's the beautiful thing about the market. It doesn't have to be all or nothing. Stocks go up a little bit, the gap between price and fair value closes a little bit, you can sell. The gap between price and fair value widens, then you buy. And that's why I bought a lot more HIMS, because I saw an uplift in valuation because their guidance was insane. Their guidance was absolutely insane. All the analysts thought it would be 2 billion, 2.1 billion, 2.3 to 2.4 billion HIMS comes out with. And based off history, they will most likely beat the upper end of that guidance as well, because they have historically. So you have an uplift in valuation plus a massive crash in price of 50%. So the discrepancy between price and value is all of a sudden gone from, oh, it's 60 and the fair value is 75 to, oh, it's 35 and the fair value is 100. I didn't want to make this video about HIMS, but I'm just like stating, this is how you need to think about investing to stay rational on calm waters. Think of crashes as an opportunity. If you haven't got that cash pile up right now, and you do believe in your long-term investments, maybe it's time to get a bit more conservative, save a few $100s a month or whatever you can afford, and put that into stocks that you genuinely think have long-term value. There are a lot of people out there that will just pump the most popular retail stocks out there because they're trying to upsell some course, and that's really how they make their money. Just remember that and stay rational. And if for whatever reason these crashes panic you, maybe it's better to just make investing a bit more passive. I wish everybody all the very best of luck with investing. Enjoy the crash. Think of it as a Boxing Day sale in the long term, right? Like this crash may go on for like another 5 months. The average crash usually lasts between 8 and 12 months, so we don't know. But think of it as a Boxing Day sale. Use your head, be rational, don't do anything impulsively. And you can drip into the market. That's the beauty of it. It's not like, oh, I have $60,000 to put a down payment on a property. When do I execute? You know, stocks are divvied up into little pieces. The average of which being what, probably $100 a share. Even if you've only got $1,000 that you can put into a different stock, that's 10 different pieces of the pie that you can buy. And even more, if that $100 stock goes down to $50, there's like more pieces of the pie you can buy when it gets even lower. That's what you've got to remember. So I wish everyone all the very best with your investing. More stock analysis on the way, and thank you very much for watching.